Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say or do should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Saturday, July 6, 2024, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and I am going to take a look at two positions in which I am nearly assigned on one and already assigned on the other. These are earnings trades that have gone against me, and I'm going to take you through some of the management and what I'm looking at doing with these trades and why it's okay to be assigned and you should not panic should you be assigned any of your option trades. But first, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So search us up and subscribe, and if you can't find it, let us know and we will get it there. All right, so moving to this week's episode, I wanted to talk about two positions that I traded recently for earnings. I did earnings strangles on them, and it was a week where I played 3 strangles. One was perfectly executed. It didn't move at all, collected all of my premium. The other one is the first one I'll talk about here. It was my FedEx strangle. That one broke way to the upside, crashed through my call, and I was deep in the money at the end of that expiration. And then the last one was Nike, which did the exact opposite and crashed through the bottom part of my strangle. And this one I was actually assigned. And I want to kind of talk you through some of the stuff that was going through my head and just take a look at where these things are. And I'll talk you through my strategy and approach with these underlyings. So first up is FedEx, and I'll put a link up above to the episode of where I had opened this strangle, and you can hear what I was kind of thinking might happen going into it. And what ended up happening was this thing had a monster move after earnings. So earnings came out super positive, super well, basically went outside of the one standard deviation. So I had played this about a 16 to 20 delta strangle. I think it was more closer to the 20 delta when I opened it. And that was going to protect me against probably about a 10 to 12% move. This thing ended up moving $45 to the upside, which was about an 18% move, which was more than my particular strike had protected for on the upside. So I was deep in the money. And this was an options expiration that, I played it on the 24th. The earnings came out, and these were options that were going to expire on the 28th, the end of that week. And so 280 was my call, and we breached that, went all the way up to just a hair under 300 and kind of flirted around with that 300, which is $20 in the money on the call side. Now, the put went ahead and expired worthless, and I was able to roll the call forward to the monthly expirations, which would be the July monthly. So that'll be July 19th, and that's the position that I actually have open right now. So I am short from the 280 call strike, collecting $1.50 on that. So I am still deep in the money. This has been fallen off a little bit. But we're still above my cost basis. Well, when I say above, it's negative because it's going to the call side, and I'll show you on the chart. So I am negative on this trade at the moment. I have not been assigned this yet. It is a possibility as I am in the money. If I get assigned this, I will basically be short one FedEx share. So I'll be short from the 280 strike. So I believe on Friday, this thing closed somewhere in the vicinity of maybe 291, something like that. So I'm still about $12, $11, $12 in the red from my strike, and I'll kind of need it to come down. I still have about 2 weeks left before the options expiration. So if we take a look at what that looks like here on the chart. So I'll pull this chart up. This red box is where my put is today, or sorry, my call. So it is at the 280 strike. I put this dashed line here. This is my break even from the premium that I collected. So you can see I did have the put. So this was my strangle. I opened it right here. Hey diddle diddle, right down the middle is what I was hoping for. This is the earnings candle that put me deep up in here in the money. And if you look back on a previous episode, I kind of called out this 300 is an interesting level where there is going to be some resistance, and we haven't actually gained this 300 level yet. And this was really what I was looking for to tell me if this is time to get out of this thing. It hasn't breached that 300 and it hasn't really gained it. So I'm kind of in a holding pattern here. We did get some price action last week on Thursday, Wednesday and Thursday. That was a little bit in my favor where, the price came back, went from about 298 down to 293 and continued to fall off a little bit. So this is really just a waiting game. And it was stressful the first few times that I kind of got in the money, whether or not it's on the put side or the call side. The call side, definitely, I am more uncomfortable on because there is really no limit to how high a stock can go. So if this thing were to start running and just kind of taking off to the moon, there's really there's no stopping, right? It can kind of go up to infinity. It won't go to infinity, but there really is no kind of circuit breaker or something that stops it, right? Where on the downside, you always go zero is as low as you can go. Can't go any deeper than zero. So there still is a little bit of volatility left in this FedEx trade, but the volatility really did collapse a lot. So if we hop over to the FedEx chart, I can kind of show you here the volatility. So this climb up down here from early May to just before earnings, which was June 24th here, you can see we really climbed up in that historical volatility. Earnings came out and you get this big volatility contraction. This is exactly what I was looking for. Previous earnings had this same volatility contraction, the same volatility contraction. Unfortunately, we got the volatility contraction, but we breached my strike. And that's just no good because, now you've lost a lot of the premium, but you're in the money. And so, I can roll this thing as we come up to expiration, but there's really not going to be a ton of premium. I'm going to go ahead and kind of keep rolling it as long as I can get premium for it. And I'll really take this trade to close to that expiration of the option. So July 19th is when this particular options expires. I will likely not roll this thing till July 17th, July 18th. I'll really kind of push it as much as I can. This is all provided that we stay above that strike of my 280 strike. Now, if we fall below that 280 strike, I'll go ahead and I'll exit this thing for a profit at that point because we'll finally get below this dashed orange line, and that orange line is my break even. So above that, I'm losing money. Below that, I'm gaining money. So should I be so fortunate before the 19th to drop below this, both the dotted line and this red line, I will go ahead and take that opportunity to exit, get my buying power back. If we stay up here in this elevated state, as long as we're not gaining past the 300, I'm going to keep waiting this one out and riding it out, and I'll keep rolling for a premium. Now, albeit it won't be that great of a premium due to that volatility contraction, and there's just not a lot of volatility left in the name. So I'm not expecting big moves because of that lack of volatility. So the other trade of that week, this one is a little bit more traditional of a breach for me, one that I'm much, much more comfortable with than a call side, and that is on Nike. So Nike had earnings, really elevated volatility, greater than 90%, just like the FedEx trade. However, when it came out, it crashed, and it crashed hard. So Nike was trading at around $97 pre-earnings. Post-earnings, it had a $22 down move, which was about a 23% decline overnight. So this was in the after hours. Now, remember, when you trade options, you're really stuck with them until the market opens. There is no after-hour trading of options. And so I know this going into it. And breaching that put side to the downside is always a risk. Breaching the call side is also a risk. And that's why when I enter these things, I have to be okay with assignment. And so I really was okay at holding Nike shares. Now, I didn't really think we would breach as low as we actually did. So, I mean, this thing swung down to the mid 70s on that down move from $97. I mean, I think it wicked down as low as like $74 on one of the days. And so okay, we breached the put, but we breached it hard. If you take a look, I did collect $1.75 on the strangle that I put. So that was both a put and a call. But there was no chance to roll. So, I mean, this thing breached. It was deep, deep in the money. I looked at rolls all the way through the Friday of expiration to like the last 5 minutes of the market, and there was no rolling this thing for a credit. So the only thing that you can do in that is you just let it expire. I could have bought it back and booked the loss. But like I said, I went into this thing knowing, hey, I'm going to be okay with assignment if I get it. I'll wheel on out of it as soon as I get assigned. I'll go ahead and wait till the volatility kind of pumps back up. Maybe we get a little bit of a gain, and then I sell some calls into it, hopefully getting called away. The benefit with Nike is they do pay a dividend. It's about a 37 cents a share dividend. And so once you're assigned, you're eligible for that dividend because you are now a shareholder. So unfortunately, your buying power does expand a little bit. So right now, as it sits, it's about a 5.6K buying power, collecting that $525 from those 3 contracts that I sold, puts me at a 9% return on capital out of that 5.6. But this is really deteriorating because it's doing nothing. I'm not actually getting that return, and I'm holding it, and nothing's happening. So it's not like that overnight, boom, I get that 9% return. That's the ideal. In this case, I'm going to hold it. I might be holding it for a week, 2 weeks, 3 weeks, and I might not get the opportunity to collect that much premium. I'll probably collect some when I finally get a chance to sell some calls against it. But again, it's not going to be a ton. And so this is where that percentage by day really starts to kind of come down, because it's not that overnight winner chicken dinner. You end up holding it, and then the percent you gain each day is getting diluted and diluted and diluted as we go. So let's go ahead and take a look at the chart here, and you'll see that there was just nothing here. So I got the top box and the bottom box. This is my call on the top, my put on the bottom. When I opened this thing here back in June 24th, that was right there in the middle, 20 delta up, 20 delta down. We had a lot of fall off, leading up to earnings. And so I thought, oh, shoot. Sometimes I wait and I put this trade on just before earnings to center this up nice in the middle. It wouldn't have made a difference here with this move. So, I mean, here is the top part of the strike, just boom, crash through, both after hours on earnings after the bell, and then again before the bell, again, another drop, kind of catching down here about the $75 mark per share. And that's kind of where we've just been hanging out. And at this strike, my cost basis is that $90 strike minus the $1.75 that I collected in premium. So you can see 88.25 is my break even, but we're well below that. If we go ahead and we take a look at the chart for Nike, much like FedEx, it's going to have this contraction, a volatility contraction, which is what we like to see. It's what I go for, but kind of same as FedEx. Once you breach the strike, here's the earnings, and here's this big volatility contract. I mean, look at this volume here. I mean, just insane amounts of volume came in on this selling. Just very, very violent down pressure, catching there at the 75 mark. So selling a call down here, I'm so deep off of that $90 strike and even my 88.25 cost basis. Looking out just for numbers, if I wanted to put something out there in the August expiration, so that's going to be about 45 days to expiration, the $90 strike is a 5 delta. And it's a 5 delta because volatility has really kind of evaporated off of this after earnings. And so I'm going to have to wait for it to kind of build back up. Hopefully we'll get some price swing up as well. And then that's going to bring that delta strike, that $90 strike, that delta will start increasing, and hopefully I can get it around, a 30 delta, 35 delta, and go ahead and sell that. But really, until I get some price appreciation, there's nothing I can do with Nike. So this thing is just going to sit there at 300 shares in my account. It's consuming, 5.6K of buying power. Like I said, I do get dividends on that, so that is kind of a nice thing. They're quarterly, so the next one will actually come out in September. I hope I'm not holding it by then, But to be honest, who knows? Some of these assignments, I end up only hanging on to for another 2 weeks. And some of these assignments I hold on to for many, many, many months. And it's something that I don't do a great job with cutting my losses, because I can still kind of collect premium on this. In this case, no, I'm not really selling premium, but I am collecting a dividend. That's just where I'm at with Nike, and it's unfortunate, but I'll admit the first time it was assigned, it was kind of scary, because you're like, oh my gosh, I'm assigned, whatnot. But when you think about it, all that's really happened is you've purchased the shares. And so it's really no different than if I'd have gone out to the market and purchased, 300 shares of Nike in this case. Now, it's a little different because I at least collected some premium versus, going out before earnings and buying the 300 shares thinking, yeah, we're going to rocket off of the moon to this thing, and then losing the same amount. This was a deep move down, so not so much of a consolation prize, but I was able to collect a little bit of money to lower the cost basis just a little bit going into it after I purchased it. But it's really no different than holding shares in your portfolio. In fact, it's exactly holding shares in your portfolio. So that brings us to the end of this week's episode. Really, it's just an example of, hey, not every earnings trade works out right overnight like I want it to. Here's two trades that breached, one onto the breach to the high side, one to the breach to the low side. And it kind of goes into this slow slog where it's not that exciting. And in fact, it's kind of disappointing because I can't quickly turn around and recycle that capital and fire it in another trade. I could book the loss and fire it in another trade. But a lot of times when you get those huge elastic movements, you will get a slight regression back to the mean. That rubber band will kind of snap and so I'm looking for a little bit of price oscillation to kind of tip back in my favor, to lessen the blow, maybe close it out for some green. And you really just have to be patient. And going into these trades, this was always a very real probability, albeit a lower probability. So I've been doing this, and 70 to 80% of the time I finish out of the money and I close that trade out for a profit. But when you're dealing with earnings, it's a coin flip. And there is that, 15 to 25% of the time where you're going to get breached and you're going to go into the money and you might get assigned. And that's something that you have to be understanding of going into the trade. And so when it happens, you don't freak out, you don't panic. You just kind of keep to the plan. And that plan is, if you get assigned, you sell the opposite option after expiration. You roll it as much as you can. If you can roll it, you just kind of keep rolling it. That's my strategy. If I can't roll it and I get assignment like on Nike, then you're just looking for that price appreciation and then selling the opposite thing. So in this case, I'll sell calls against it to get those shares called away. And while I wait, I will go ahead and be eligible for the dividends that are out there and collect those dividends as I wait for that price appreciation to come, and selling calls against that while I wait for that day. So hopefully that gives you some insight onto what happens when you get assigned. Hopefully you are having more success than that out there, and a lot of your trades go more according to your plan and not your backup plan, or the worst case situation like we'd had here of the breaches of the strikes. But good luck out there, and remember, think outside the block.